Well, good morning, everyone. Welcome to our annual economic update. As usual, last year and last quarter weren't boring. We hope to give you a general overview of the key issues impacting the U.S. and global economies. We're focusing on the areas that will impact most of our attendees. So please note your questions in the chat box. There's going to be ample opportunity in the latter part of the presentation to answer them. Several of you have already submitted questions in advance. We thank you for that. We'll address those when we begin the question portion of the presentation. As many of you know, Sean and I had the opportunity to make this presentation live last Friday here in Jacksonville and had a wonderful event. I think there's a lot going on out there. So without further ado, let's review a year when we actually got some answers to long pending uncertainty and also got lots of new questions. So hope you enjoy our presentation today. Joining me as always is my partner, Sean McCabe. Together, he and I'll strive to help you make some sense out of the economy and out of the market.
All right. Good morning, Marshall.
Good morning, sir.
All right. Welcome, everybody, to 2026. If you weren't part of our live presentation last week, like Marshall said, we welcome you here. Thank you for joining us. I would encourage you to jump in. Marshall and I had so much more fun being in front of everybody, and questions come and go as we go out through the presentation. So keep that in mind for next time we do the live one. Love to see you in person. That being said, my one-word New Year's resolution for this year is signal. I have a group that I work with, Marshall and I work with other CPAs and everything and financial advisors, and we were sharing our business plans for the year. And long story short, there's a video out there by Kevin O'Leary, and he's talking about how Steve Jobs and other key executives were so successful, and that's their ability to cut through all the noise and focus on more signal. So that's kind of my approach today, and Marshall's approach today with you guys is to really cut through the noise of what we heard in 2025 and focus on these things that bring ultimate signal in 2026. And so that being said, we're going to cover these 8 topics with you all today: the markets, AI. You can't turn the TV on without hearing about AI. Energy, the economy, geopolitics. Marshall's going to have fun with that one. U.S. politics, equally as fun. Of course, there's been a big tax update. We'll touch on that. And then lastly, we're going to talk about interest rates. That being said, hopefully, again, we'll help you cut through a lot of the noise, focus on the signal, those things that are important, those things that make a difference in our lives, and get us focused. So up first, Marshall's going to kick us off with the market update. Marshall.
Thanks, Sean. Well, 2025 was the tale of two markets. I'm going to refer to them as the magnificent and the not so magnificent. The following is made for informational purposes only and is not a recommendation to buy or sell any security. I want to make that perfectly clear. So our question is, who are the Magnificent Seven? I know you hear about this all the time. Our regular investors know who these players are. But the Magnificent Seven are Apple, Amazon, Alphabet, which is Google, Meta, which is Facebook, Microsoft, NVIDIA, and Tesla. You'll note that the S&P grew 16% last year, our top line on the screen, but the Mag 7 grew 23%, while the other 493 only grew 13%. So note that in 23 and 24, the Mag 7 grew 76%, 48%, representing 63 and 55% of the total S&P 500 respectively. All right, that's a lot of numbers. That's a lot of percentages to throw at you. So here's the reality. Mag 7's been smoking for 23, 24, 25. S&P 493, the remaining of the 500, have done okay. In a normal year, I'll go back to 24 for the S&P 493. Normal year, you get 14%. You're probably reasonably happy with that. But if you kind of look over your shoulder and you see the Mag 7 back in 2023, and they're hitting 76%, hey, you want that 76% because that's pretty nice. So we're going to talk about investing in the S&P 500 broadly, and Sean's going to drill down more on these companies later in the presentation. So let's look at earnings performance. Why have the Mag 7 been so popular from an investment standpoint and from this purely public attention? Everybody wants a piece of this action. Well, we go back to 21, and the Mag 7 grew 60% in their earnings growth. That's pretty good. I think by anybody's standard, that's great. 22 was a challenging year. Then we look at 3, 4, 5, and projections for 26, and you're still well above 20% in those years. Some cases double that historically in 24. So you compare that with the S&P 493, and you can see that, well, 25, 9% earnings growth, even though their stock grew better than that, their earnings really only grew 9%. And as we all know, at the end of the day, the market comes back to earnings. That's what really counts. What are you putting on the bottom line? I want to talk for a minute about the shift in economic order. I'll pose the question first. Are we seeing a macro shift in the economic order of the market? The reason I say that, if we glance back to 1985, and you can look that this was very industrial. We had General Motors, we had General Electric, we had, the oil companies all in here, Kodak, DuPont. I mean, when you think of American industry back during the mid 80s, that's who you think about. Now, yeah, you had some technology in there with AT&T, but that was the basic method of communicating. We had the entree of the personal computer, and so you had IBM getting into the picture as well. But the personal computer was a minor part compared to the massive corporate move to computers. 1995, we're sitting there now, we're seeing a little bit of a shift. We're getting the pharmaceuticals coming in here. Baby boomers are starting to mature, so the drug companies are doing well. Personal consumption from people like Procter & Gamble, Coca-Cola, you can see that there's a little more of a shift to the personal side of the thing and pharmaceuticals. By the time you get to 2005, pharmaceuticals are hitting in full swing. Boy, those baby boomers didn't do too well at this. So as a result, you see companies like Johnson & Johnson, Pfizer, all doing well. We still see a little bit of the oil influx in here, but look what has happened to my IBM as a percentage, changing from 85 to 2005. You notice there's a couple of names that aren't in there yet and don't really emerge until 2015, and that's Apple. Apple hits in 2015 because between 2005 and 2015, the cell phone, the applications, all the things that drive Apple's growth are in there. You still have a little bit of oil with Chevron and Exxon in there, but look how we're shifting now to Apple and Microsoft in 2015. But by 2025, it's tech, it's AI, it's Apple, it's NVIDIA. Where the heck was NVIDIA in 2015? Microsoft still hanging in there. Amazon, consumer consumption as well as AI. Alphabet, Meta, Tesla, Broadcom slipping in there, and then a conglomerate that owns pieces of all those and others, Berkshire Hathaway and the big bank, JP Morgan. So interesting things of how we've seen market order shift. And the question becomes, and I don't have the answer, of course, what happens between 2025 and 2035? Sean, who's AI and why should we be paying any attention to them?
If only AI was a person, man, that'd be hard to define. So I do know, though, we cannot turn the TV on or the radio or any kind of news media, schools, works, anywhere we go and not hear that term AI, artificial intelligence. And the biggest question I have for all of us on this call is, are we seeing a major shift or is it just a bubble? It's the headline of the decade, right? It kind of feels like the 90s all over again. Something about that internet thing, Marshall. Remember that when that came out?
I think so.
So I'd asked during our live presentation, Marshall, you can advance the slides because it brings the bullet points on. But if it's just a bubble, I asked everyone to kind of raise their hands, or if they think it's a fundamental change, kind of to raise their hands. So moving on, I've got 3 arguments for each one, and I'm going to go through those first, starting with the bubble arguments. And then I'll jump into the fundamental change arguments. So next slide, Marshall. The first argument I have for it being a bubble is, like Marshall already pointed out, 7 stocks account for over roughly 46% of the S&P's return. That screams bubble, if nothing else I've ever seen. Secondly, you've got big companies who are way outside their average growth that we've seen in history, right? For instance, you have NVIDIA, who had a market cap of 400 billion in 2022, and now they're over 5 trillion just 3 years later. That's a 12.5 times return. Right, wrong, or indifferent, that's where the market has them priced. People who've owned it made a lot of money, but that is definitely some semblance of a bubble. And last thing is, there's a lot of questions out there revolving around whether AI will ever meet the return on investment fundamentals that we look for. So let's jump into AI versus Mag 7. I know Marshall talked about this a little earlier, but just this slide just kind of illustrates it a little bit differently. Bar charts usually do a good job of doing that. And if you're looking at the S&P 500, which is that little green bar, and then the groups of bars are years across the bottom, 23, 24, and 25. Back in 23, you can see that NVIDIA, their performance was about almost 250% return in that year, whereas the S&P average was only around 25%. So keep in mind, NVIDIA is included in the S&P 500, right? Marshall said, you have the Mag 7 and the not so Mag 493. So just looking at that from that perspective shows you just visually, wow, these 7 stocks have really run away, and they're pulling up that return of the S&P 500. And the next thing I wanted to move on to is valuations. Kind of back to that NVIDIA example. Next slide, Marshall, where we have NVIDIA valuations. And one of the things that we measure or we look at, and it's kind of, if you're a student of the markets, it's kind of something you first look at with companies, and that's the price to earnings ratio. And then you compare it to other companies, you compare it to benchmark. But first, just to kind of, and I've talked about this before, kind of highlight that first indicator. What is price to earnings? It is what it sounds like, right? It's the stock market's price, based on the amount of earnings that the company has. Simply put, if a company was worth $1 million or had $1 million in profit, and that stock was sharing at $1 a share, it has a 1-time PE. It's trading at par, if you will. But if you have a company that has $1 million in profit and it's trading as if the value it would have, was at $10 million, in profit, then that company, that the stock would be at $10 a share. I know I'm not being super clear there, but the biggest thing to compare there is, how does the PE compare to the market? And in this instance, the S&P 500, all of the 500 stocks that are in there historically run between 16 and 20 times earnings, with a 16 to 20 multiple, price to earnings multiple. And you've got companies like NVIDIA that are trading at a 45 times multiple. So people are expecting that company to do 45 times its earnings. And there's only 2 ways that company will ever meet that expectation. And said differently, PEs mean revert. The average of the S&P 500 is between 16 and 20, right? Call it 18. We'll meet in the middle. It's 18. So if we think about this and we think those historical averages, NVIDIA will eventually come back to that one way or another. And there's only 2 ways to do it. The price has to retreat or the earnings have to come up. Okay. So, and it doesn't happen linearly, it happens over time. The stock price can move sideways for a while the earnings come back. But the simple point here is, if you look at price to earnings compared to historical averages, it's way outside. It's an outlier. Kind of an argument again, pointing to kind of a bubble. All right. So digging into the next argument is whether AI's return on investment is there or not. The first argument really kind of sits again on the companies, and will these companies make enough money to justify the investment that's going into them? And I said besides NVIDIA on this slide, because they're the chip maker. They're literally providing hardware for all these companies that want to implement and sell AI. So really, is their valuation unfounded? Not really. Is it outside the normal realm? Possibly. But they are making money. Their revenue is there. Their forward earnings is there to support that kind of valuation. That being said, again, like Marshall said, we're just looking at this from an educational standpoint. I'm not recommending anybody go out and buy an Nvidia. Just kind of pointing out that this could be a bubble, right? And using that as an argument for that. But the question is, are companies going to make enough money to justify the amount going into the infrastructure, the upfront costs, to justify the valuations that are out there right now? And my next bullet here shows that infrastructure costs, it's kind of a big question mark, but I've read up that to build out what we need to build out to support the forward-looking AI usage is about $2.5 trillion in infrastructure. I was listening to an article or a video on CNBC the other day, and I think it was when President Trump was at Davos, and someone was telling him about what the footprint of, call it an AI farm. I don't know what the technical term is, but it'd be the size of Manhattan, and it would cost $5 billion to build. That blows my mind. So that kind of infrastructure cost is, where is AI monetized enough to not only return that cost at par to break even, but to make the money that these companies will need to make to justify the PE that we're seeing in companies like NVIDIA. And then the question is data the new oil? So think about all the money that's flowing and all the geopolitics and politics that are around it. And big data was kind of the term in the early 2000s, right? Big data, big data, big data. Now we're using big data and computing on that and coming out with algorithms like AI to give us answers to things. But who controls it? Think politics, think control, think OPEC to oil. Where is this going? Who will control it? Who will regulate it? Who will protect the masses, if you will? So kind of leaning into, is it a bubble? I mean, there's a lot of missing pieces and a lot of things to consider here. So my final thought on the bubble argument is, we are seeing a classic bubble behavior. Like I said, massive capital inflows, extreme valuations, and expectations that everything with the word AI in the name will change the world. Kind of sounds like the internet all over again. But if history tells us anything, some of these companies that are here today, and again, I don't have a crystal ball, I don't know which ones, but they're not going to survive. They're not going to be here tomorrow. Who remembers Netscape? Okay, let's shift to the AI shift arguments, pun intended, I guess. Is it a fundamental shift? So I got 3 arguments for that. No different than past technologies. I kind of gave you a hint to that already. While not fully realized, early data is promising. I said that there's a lot of value substantiating, or a lot of support substantiating the valuation of NVIDIA and other companies. And we'll dig into a little bit of that. And then transformative infrastructure. And I'm going to go through a couple of use cases as to where AI is actually being monetized and maybe not even have its full value yet, to kind of say, hey, maybe this is a huge fundamental shift. So jumping into past technologies, I know none of us are alive for this to have first principle exposure to this to make this argument. But if you're looking at past technologies, railroads in 1840s, Marshall, if you wouldn't mind going to the next slide for me. Railroads in 1840s, there was massive speculation and then subsequent collapse getting into the Great Depression. A lot of the companies who laid the railroads and built the early infrastructure in this country were no longer around after the 1920s, 1930s, whether via consolidation or, again, pure collapse, and then other companies are around to pick up the pieces. But who is around today running the railroads like CSX is definitely not who was laying the foundation back in the day. The second point here, it's very similar to past technologies in that it's a shift in infrastructure, not just a bubble for today, is in the internet. In 1995 to 2000, the NASDAQ was up 400%, right? Kind of arguing against, is it just a bubble? And in 2002, it was down 78%. Again, thinking about, well, the internet's still here. And again, I mean, if you think about it, AI lives kind of on the internet. It was a fundamental shift. It was an infrastructure shift. But the companies who trailblazed it, some of them aren't here. Think about Netscape. All right, perfect example. That was the first internet company to go public, trailblazed the internet, and they're no longer around today. Smartphones, they launched in 2007. And I actually thought of this since we did the live presentation. I didn't really have a good example, but I do now. Who remembers the BlackBerry? My goodness, that changed my life. I had the little keyboard on there. I actually prefer the QWERTY keyboard on the phones. I can't. I type like a toddler on my iPhone. It's crazy. But reality in motion. If you remember back in the 2000s, maybe even the late 90s, that's all we heard about. RIM, 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 RIM. And then where are they today? Where's the BlackBerry today? They fell behind. They trailblazed information on your phone, data on your phone, and then Apple came in, Android came in, Google, if you will, swooped in and took over the market. So again, it's very, very similar to past technologies in that it may start out feeling like a bubble and have this huge ramp up, but there is a lot of argument for that. This is a huge change in the way we do things as I was going to say as a country, but the world. So I want to talk about the next idea here of revenue growth. Early into this, there's some really good support for the AI space looking very, very promising. And looking at this chart, AI startup revenues have grown, as we know, exceptionally quickly. Marshall had touched on a lot of companies that weren't even here 5 years ago in that S&P 500 mix. And looking at OpenAI, they reported 13 billion in earnings August of 2025, and that's, to them, that is $1 billion on an annual run rate. That's continuing money as long as subscribers continue to stay subscribed. That's starting to get a big market penetration and start to substantiate some of the fervor that's in the AI investment world, the return on investment. Looking at Anthropic, right, not too far behind them, but they're posted 5 billion. And you got XAI, which is Elon Musk's company, barely showing up on the radar there, but early signs show that revenue is there for the use of AI. It's not just free Google search or whatever. There's true ability to make money in this business. Also looking at user growth, getting into what ChatGPT continues to report, their weekly users was 800 million as reported back in October of 2025. 800 million. I think the last census in the US put total US population around 350 million. So 800 million is a pretty good uptick on who's actually using ChatGPT on a weekly basis. So I think there's a good argument for a use case for it. And also the revenue is starting to show positive signs that there's money to be made here for these companies. To kind of drive that point home and kind of bring it back to you for you to decide, is it just a bubble or is this a fundamental change in infrastructure? Got 5 use cases here. Engineering. I did a turnaround for an engineering company not too long ago, and their survey manager came to me and said, "Hey, I want to buy this drone. It's like 10 grand." I'm like, "Cool." He goes, "I also want to buy the software. It's about 100 grand." I was like, "Whoa, tell me more." And long and short, they could buy this drone. They could fly it over a field and get a topography reading, basically how the field would, be laid out on a survey. And I can't remember exactly the time frame differential here, but they could do it in hours, whereas it would take a survey crew 2 or 3 days to lay all those points out and measure it with the old school way of doing it, thereby saving the company thousands and thousands and thousands of dollars to do this. So just a very simple, quick example of how AI and technology are improving the way we do things and becoming a fundamental shift. Medicine, reading, we had a friend of ours at the economic update last week. And if you're on this call, you know who you are, but you were talking about how, quantum computing can review medical reports in a way that even AI can't do now. So that being said, saving lives, saving money, and just making advances in medicine that we've never seen before. Legal research. Marshall and I obviously have to do a lot of legal research, especially with the new laws that came out on the tax side when we're helping people with tax planning. There's things we have to look up. And the way Marshall came up doing it was going and reviewing on LexisNexis or wherever he went, Westlaw, to go look at case law to see how some of these cases have been settled and how the tax law has been interpreted, getting into authoritative guidance on what does the law say about this particular transaction, how it be handled. What would take Marshall 2 or 3 hours, maybe longer, to do a piece of research, I can jump into co-counsel software by Thomson Reuters, which goes to the same places that Marshall went to in an instant and pulls up case law, pulls up authoritative guidance, and gives me an opinion to go finalize my research. So I can find an answer within 30 minutes that may have taken Marshall several hours to do now. But that being said, saving tons of money and time for us and our clients having to pay us for that research. They don't have to do that now. We can get it done a lot faster. One thing I thought was interesting, my cousin, true story here, is a cloud architect for Adobe. And he was telling me the other day that a lot of his folks, when they're working on projects now, do more debugging than actually writing of software, meaning that the tools they have available to them can literally write code for them. They just need to go through and debug, which is part of the process of writing code anyway, to get their software up and running, thereby saving time and money across the board. So again, for pretty simple use cases, there are thousands of more ways that companies will save a lot of money on AI and justify the spend that they will be spending on getting access to more reliable and faster, more accurate tools that use AI. So kind of final thought on whether it's a fundamental shift or not is AI is reducing the cost of thinking the way the internet reduced the cost of communication and commerce. And in my opinion, that never goes away, and it causes a fundamental shift in our everyday. So what do you think? Is it just a bubble, or is it a fundamental change? Marshall and I, we think it's both. AI is both a bubble and a permanent shift. And I'd say this, they're not mutually exclusive. It's not one or the other. And what we've seen in past technologies and past advancements in the way our infrastructure is changed, or fundamental change in how we do things, they often arrive together. You'll see a big run up in the bubble, and then when the dust settles, we'll see who's left. So my final thoughts on AI and kind of bringing it together. What do you do with all that information? What do you do with all the noise that's coming out from AI? It's pretty simple. Our job isn't to chase hype or fear collapse. Neither is yours. So don't do that in your portfolio. Our job and yours is to own durable businesses that use AI as a tool, because we know it's here to stay, and they're using it to become more profitable. Not companies don't choose companies that depend on AI as a story just to survive. So I like this last slide I've got in here, that slow is smooth and smooth is fast. Just take it slow, be smart, keep it smooth. So that's our take on AI. I hope if you have any comments or questions on that, throw it in the chat. We'll hit it at the end. Jumping into our next point of interest, one of the 8 areas that are a lot of noise. Energy has actually been pretty quiet, kind of contradicted myself there, but it is one of the biggest contributing factors to our economic progress or slowdown. And it's worth talking about pretty regularly because it has a pretty good grip on when we see progress or slowdown. But like I said, it's been pretty quiet lately, other than the last episode of Landman. If you've been tuning in, fantastic show. Please don't spoil it for me. I think I got 3 episodes left, but learned a lot through that. And kind of, obviously Landman's a little bit Hollywood, if you will, but it did prompt me to go do a little of my own research and dig a little deeper, and it's pretty interesting. But there's really only 3 things in oil that matter: demand, supply, price. So let's dive into demand. I made a change for those that were in the live economic update. I had posted what the change year over year was. It was 850,000 barrels per day between 24 and 25 that the demand increased. But I think it's clearer to say what the demand was in 2025 for the U.S., and that was 20.5 million barrels a day in 25 was U.S. demand for light sweet crude oil. And the forecast for 26 is right around 20.6 million barrels per day. So demand for U.S., a slight uptick. I don't know if it's notable to really get too excited about, but there you have it. Moving to supply. The U.S. is expected to produce about 13.4 million barrels a day. Obviously that's short of our 20 billion barrels of demand. So obviously we're importing some of that. And then the global oil supply is projected to grow faster than demand for 26. So again, this is probably why we're not seeing a lot going on here. Supply and demand is pretty comfortable, pretty stable. U.S. inventories are a little bit lower than normal. But with the overall supply starting to pump out like we've seen, Venezuela and geopolitical information aside, hopefully we're starting to see the U.S. demand and supply kind of level off there. So let's lead into price. When you have balance in trade on supply and demand, you usually can see the price stabilize as well. The sweet spot for oil, this is straight out of Landman, but also I've researched it, is right around $65 a barrel, 60 to 70. So I just nailed it in the middle, about 65 a barrel. The current price as of 122 at 10 a.m. when I last checked it was about $59.49 a barrel. And of course, with everything being as balanced as it is, the projection for 2026 is about $60 a barrel. Again, it's quiet right now, but that could very easily change, as we all know. And I'm chuckling because I know what's coming in Marshall's geopolitical risk slides. So let's move on to the economic update. Marshall and I hit these high points pretty quick every quarter. We have our four favorites. We have growth, which is measured by real GDP, inflation, unemployment, and then where's the Fed policy and the Fed funds rates that kind of help balance that out. We think those are the four things that we all should keep an eye on to kind of give us an indication of where we're going, where we're headed, and why is policy the way it is. First up, real GDP. Since 24, we saw 2.8. Q1 GDP was actually down 0.6. Q2 back up 3.8 growth year over year, and then Q3 25 was 4.3. We have Q4 25 green and highlighted yellow because we don't have an actual number yet. It was supposed to be posted, I believe, yesterday or this morning. But the last Fed forecast showed it at 5.4%. So we'll keep an eye on it. We'll let you know what goes on. One thing I do like to point out is, what do these numbers mean, right? The historical average of growth GDP in the U.S. Between 47 and 24 is 3.21. For the latter half of 25, and it looks like the forecast is 26, we're well above that. So we are seeing growth, which is a good thing. More important than just that number and understanding that, hey, we're growing. We have controlled GDP, we have controlled growth, is what's that mix? What is making up GDP? What's driving it? And there's two notable facts I want to point out. Number one is consumption. I know these charts are small on your computer screen, so if you zoom in a little bit, you can see that consumption contributed to about 2.4% of the Q3 GDP. Again, we don't have the Q4 numbers out yet. And then one cool thing that we haven't seen in quite a while was the net exports of the US actually contributed to GDP by 1.6%. Historically, from 20 to 24, we usually are negative. We're negative 0.1% on our exports. We're losing money on our exports. We're losing GDP. But very interesting to note, and I know Marshall touched on this too, and he's going to again, consumer demand is there. Consumers are spending. That's what's driving GDP. Our exports driving GDP, and a couple other pieces in there that haven't really moved much in the last couple of quarters. So we're not going to talk about that today, but you can kind of see what's driving GDP right now. Pretty good sign. Moving on quickly to inflation. In 2024, the total CPI was 2.9. As you read the slide, Q1 2.4, Q2 2.7, Q3 3.0. Now you start to go, all right, there's been a slight uptick in inflation. Now maybe we can see why the Fed did a quarter point bump in Q3, another quarter bump in Q4, and the results of Q4 showed that those bumps worked. We got inflation to tick back down to 2.7. And again, just a favorable note here that inflation in this country from 1914 to 2025 historically averaged around 3.2%. So we're below our historical average. And I think that's why the Fed had paused. I know there's some political issues there, and Fed chairman's about to roll out. But in my opinion, based on inflation, with the tick down like that, there was no need to drop rates another quarter point. Just like GDP, the metric is cool and all, and where does it tie out with the average, but what is driving it? This slide highlights the makeup of inflation, and the story is simple again: consumer spending and housing. Really, really hard to see, but we love this slide because if you just kind of step back and look at it, you can see that huge run up where green is energy. And Marshall's got a point. I want him to jump in here to make it, but in those periods, you can easily see what's driving it. You had energy, you had shelter, which is the dark blue, and you had dining and consumer spending, if you will, in that light blue. And then core goods were really expensive during that period. But if you fast forward to that far column over to the right, the two biggest section of that bar that's driving inflation continually higher is, again, dining, recreation, and other services, consumer spending, and shelter. Those are the two biggest causes to inflation right now. Marshall, did you have a point you want to make on this slide?
Yeah, I really do, Sean. Thanks. If I could draw your attention to the green bars in the center of the graph, and let me put that into some chronological and political aspects for you. Sean and I sit here virtually every meeting and we'll throw out this one phrase, and it's politics versus policy. And politics, in my opinion, is a lot of hot air. Policy is when you make rules, regulations, shifts. Uh, and if we can go back to January of 21 on the slide, and there was a major shift in policy from a new administration coming in at that point. And that administration shift in energy was dramatic. And so, what resulted from that shift in policy was a substantial increase in energy prices. As Sean alluded to, oil, petroleum is in everything. And so, if the energy prices go up, look what happens to dining, recreation, uh, shelter. Petroleum products are in virtually everything inside of a home. So we immediately saw this substantial rise in inflation. And I say it was primarily driven by the increase in energy costs. So we shift that forward, we get back down to January of 25. We have a new administration. We had the midterm change, if you will, in 2023, but follow up in other enhancing things to drive energy prices down. We all feel it when we fill up at the gas pump that we're not paying as bad as we were at that point. But, the reality is it is happening. So I just piggyback on that again. Politics versus policy, we have to keep control of that.
Appreciate that, Marshall. Always the case. And again, it's Hollywood. We're not making investment decisions on what we see on TV or anything else. But watching Landman and hear Billy Bob talk about how oil isn't everything is kind of yeah, that's true. Anyway, okay, so jumping into help wanted, getting back into some of the economic stuff. Again, this is a really good argument. Again, why unemployment was ticking up quarter to quarter all through 25, and you kind of look at the Fed and go, all right, you want to get ahead of it, let's drop a quarter point in Q3, maybe we'll drop another quarter point in Q4. The results of unemployment, again, we got to wait and see what Q1 of 26 pulls out to be, but early reports are basically saying looks like we're starting to see some easing in the unemployment, but again, we don't know yet. We'll have to see how this quarter plays out. And again, kind of getting back to where are we in the grand scheme of things, historical unemployment. And I know we've had some big runs up in unemployment. I think the historical high was during COVID, was the average runs around 6.25%. So we're below that. So kind of getting into consideration with the Fed's dual mandate of maximum unemployment and keeping inflation in check, I can see why the Fed paused. So really, I just wanted to wrap up on that and kind of move into the Fed funds rate. Why are we where we are? With the Fed's inflation mandate of 2% as the benchmark, considering the trend since Q1 in the initial softening of the job market, again, it may be more easily understood why the Fed decided to cut rates to 2 times back in December and earlier last year. Right, wrong, or indifferent, we'll find out at the next Fed meeting, which I think is in February, but the Fed decided to hold rates steady, and I can see why. All right, so looking at our crystal ball, what does our crystal ball say where we're going, where we're headed? Let this sit in for a second. Definitely ask us again later. Honest opinion, though, is GDP growth is strong and broadening. Exports are contributing meaningfully to that GDP, which is historically unusual, and it's a positive thing. Unemployment remains low by any long-term standard. Inflation seemingly has cooled dramatically from its peak, as we saw back on that chart where energy was contributing a huge part to what inflation was. The Fed is no longer tightening aggressively. With yesterday's pause, I'm feeling pretty good about it. And to me, this is all a constructive macro backdrop. I would also say that it is not a signal to abandon discipline or chase returns like we talked about earlier with AI. It is just a signal that the system is functioning well. And I say that the data gives us confidence, not complacency, allows us to invest clearly, not with urgency. So back to my earlier slide, with slow is smooth, smooth is fast. As of the moment, the economy is cooperating. Now our job is simply to remain disciplined. Marshall?
All right, but Sean, We all know consumers say they're very uncomfortable about the economy. The impact of inflation and tariffs is on purchasing power, the uncertainty, the future costs of things like phones and vehicles and shoes have caused consumers to rethink purchasing. Despite lower inflation, low unemployment numbers, decent job openings, consumers still aren't confident because of uncertainty. Let's look at the consumer confidence index. The thing has dropped 10% in a year. And you would think that with the election over and many of the things that occurred positively, that would be great. But the key word we know that has upset or created the uncertainty is the T word, tariffs. And we'll talk about those a little bit later. But the consumer is telling us they're very unconfident, but the leading indicators are holding steady. Despite a slight decline, they continue steady, which contrasts what the consumer confidence level is indicating. And the interesting thing is that during the presidential campaign, LEI dipped more than we've seen with the tariffs. So it's just very uncertain, very crazy kind of what is happening here. But it will be interesting to see how this plays out in the coming months. To summarize, though, consumers feel the economy is worse than it actually is. My take on that, it's what you get from mainstream media and social media telling you that times are tough, but people are out there, they have jobs, and they're spending money.
So I want to quote Fed chairman yesterday. If anybody was watching, he straight up said the consumer is filling out surveys that sound really negative and then spending. I don't know how you reconcile that.
I don't either, but Sean, you and I were the only ones watching. We're the geeks. These are normal people that we have on the screen. They don't listen to the Fed for an hour. They don't listen to an hour and 36 minutes Davos speech. Come on, they have us to summarize all that for them.
That's fair. That's fair.
Oh gosh, I mentioned Davos. That's the drive. Let's talk about geopolitical. Hey, everybody loves and peace, love, and happiness out here. There are very few places where I think that's happening. So, starting with the geopolitical tensions, we've got Hamas versus Israel. We have a peace accord. Not much has changed since last quarter. Interestingly enough, you may have seen pop up on my screen. I just got a call from Israel. I'll call him back after the meeting, but my client in Israel and I speak very, very frequently. And he keeps telling me that Hamas is not the threat. Everybody's getting ready to start rebuilding in Gaza. But the fear is that the U.S. will bomb Iran and Iran's retaliation will be Israel. That's a real concern to the people who live there. And so we have to have that on our radar. As we've seen with most recent strikes, there's very little advance notice, but they have happened and they probably will continue to happen. North Korea and Russia versus Ukraine. It's been quiet in the press, but it hasn't been quiet on the front. That's still a war that's raging on. Skipping down back to U.S. and China. Once U.S. got into Venezuela, of course, a lot of the relationships between the Venezuela regime and China have gone by the wayside. So that hasn't helped on the U.S.-China relationships. We all know about the T word there with tariffs, but at least everybody appears to be talking. U.S.-Venezuela relations, we don't exactly know how that's going to shake out. We keep hearing that it's going to be better. There's going to be great diplomatic relationships. Of course, everything's going to be fabulous, is what we are told. But we haven't seen exactly how that pans out yet. And how do you move a socialist country to a democratic country and change that culture and mindset back over is yet to be seen. And now, of course, we have U.S. versus Denmark relationships. In all honesty, I could spend probably an hour explaining why Trump wants Greenland, but we're not going to do that today. We don't have time. Let's just say it's strategic. Lots of things going on there. So lots of tense areas globally. I suspect that this is going to continue through the remainder of the year. There may be new opponents. I did not mention Cuba at this point. but I'll just throw that hint out there that that may be coming on the horizon. And, we may end up having to issue numbers to countries and issue a program because it seems like the game gets a little bigger every single day. Well, US politics, hey, here we go again. I could sing for you a little song like tomorrow, tomorrow, we shut down tomorrow. It's only a day away. See, I can't sing, but we can kick the can down the road. Here we go again. Government will shut down. There will be a bill to get it reopened. How do we get the bill passed? Very simply, you hold out until you get some pork for your district. As soon as I get pork for my district, hey, you get my vote. Congress has been doing this ad nauseum for decades. It's become the normal course on how you get things done in DC. The end result is more spending, no real cuts, and of course, an increase in the deficit, or as we like to say, business as usual. The US debt remains unchecked and it's running rampant. We get a little bit of money in from tariffs and suddenly, oh, let's do a tariff rebate. Well, why don't we pay down this debt we've got sitting out there? That would be okay. I got on my soapbox. I apologize, Sean. So let's do the T word, tariffs. It's hard to believe that when we had our annual economic update last January, tariffs weren't even part of our daily vocabulary. Little did we know that within a few weeks, one word would bring the market tumbling more than 20% within a few weeks. Of course, it wasn't different this time, and the downturn created an awesome buying opportunity for those who were hoarding cash. The tariff impact is still developing. It varies from industry to industry, how quickly an industry can resource its products from other countries or domestically. So, what really is a tariff? It's simply a consumption tax. It's like a sales tax. Obviously, it gets passed to the consumer. We've heard the $2,000, now I think $2,200 rebate. If that comes to fruition, it will be close to election time. Oh, I just pontificated, Sean, sorry. So it has, but most votes, the most voter impact for the buck. The burning question is, what is the market impact? The jury's still out on this one. Chairman Powell says it'll take several quarters to fully identify the impact, and thus far, he's been right. So, Sean, save us some taxes.
All right. Yep. So this stuff is already passed. It's already in the law. We can actually save you some taxes, not conjecture or new bills that need to get passed. So that being said, there's a couple of things here to talk about. One is what can you currently take advantage of from your 2025 taxes, and what you should be doing for 2026 for tax planning purposes. So in 25, 5 really high level things. There's a lot more to it, but this affects most people. Standard deduction increased, so we should all be seeing a little bit more come back to us. The enhanced deduction for seniors is in play now, meaning $6,000 if you're 65 years of older, you get an additional standard deduction for that. So if you're married, filing joint, there's a nice little $12K there for you. There are phase outs involved with that, so if you have questions, just let me know, or Marshall know. We'll be able to help you with it. State and local tax SALT cap raised, so now you can take up to $40,000. Again, there's phase outs, but at minimum, even if you're above those phase outs, you'll still be able to take the prior 10K limit. Another cool item was the auto interest deduction that went in effect last year. If you bought a new U.S. assembled car, that's keywords there, in 2025, you can deduct, and of course you financed it, you can deduct up to $10,000 of that interest. Again, phase outs. If you're over 200K married and filing jointly, you won't be able to take that. And then again, no tax on tips or overtime, up to 25K on tips, and or up to 12.5K on overtime. Again, there are phase outs. Looking into 2026, talking about some tax planning strategies you can make. Again, all of the things, provisions from 2025 roll over to 2026, including higher standard deduction. It bumps up again in 26 for us. The charitable deduction options, non-itemizers can take $1,000 deduction. Those are for cash gifts, so it's kind of an above the line deduction. Don't have to itemize. You don't have to do Schedule A for it. If you are an itemizer and you are going to use Schedule A, there is a new 0.5% AGI floor, kind of like medical. You have to be over that 0.5% AGI floor in order to start taking that deduction. In addition, if you're a high income earner, meaning you're in the 37% tax bracket, there is now a 35% cap on your total itemized deductions benefits. So that does kind of impact your charitable contributions. If you're in that scenario and you want us to run some work for you, let us know. We can help you out with that. And of course, I'd be remiss if I didn't talk about the estate and gift tax exemption. It has moved to $15 million per person, and that will be indexed for inflation, and it is made permanent. And unless Congress changes the law again, you can exclude $15 million of your estate from estate and gift taxes moving forward. So, Marshall, I wanted to keep that brief. If folks wanted to learn a little bit more, we can point them to this slide. Yep, you can click that. Scan that QR code. That'll lead you to our YouTube channel. You can go watch. I think it was about an hour we did kind of reviewing all the provisions of the big, beautiful bill, OB3, as I like to call it. And then again, we always post our economic updates there, so you can go back and watch previous economic updates. If you have trouble sleeping at night, feel free to tune into those. And lastly, interest rates, Marshall. I think it's the last bit of noise we want to discuss to send our viewers home a little more confidence and signal. So back over to you.
All right. Well, a critical driver of U.S. borrowing costs, of course, are 10-year treasuries. The 10-year yield continues to waffle slightly, but it still hasn't made a defining move in either direction. And remember that key driver of that rate is economic uncertainty and cuts from the Fed. So with no cut yesterday, no movement in the 10-year treasury. Same thing with the 30-year mortgage, still holding about 6.09 as we speak. Fluctuates a little bit, just waffles around is like the term I like to use. But for mortgage rate, again, the 10-year treasury is the historical driver. It's usually about 2.5%. Right now, it's a little below that from the 10-year treasury yield. But obviously, this is something that we'll have to continue to watch as additional Fed meetings come up or worldwide events. Investing in uncertain times, we always like to hit this. This is my reasons to sell slide. We switched it around. We usually have the one that talks about the reasons not to buy. Well, this is just looking at it a little way. There's always a reason to sell. And you see all these things, and most of us on this call have lived through each of these things. And every single time we heard the market was going to fall and would never recover, yada, yada, yada. Well, in spite of the reasons to sell, the market keeps doing this. And the bull market continues. The growth in the US economy and world economy continues. And as a result of that growth, of course, and someone has sent us the question ahead of time of, are we due for a correction? The answer of a correction is a 10% decline or more, but less than 20. Historically, we'll get one this year. But what will be the stimulus? I mean, I look back when we met last year, as I mentioned, we hadn't heard the T word. We hear the T word, boom, we're down 20%. So we'll have one. I don't know when, and I don't know what the stimulus will be. But they're perfectly normal, part of the process. And as you can see from the chart, if you'll stay the course, you're handsomely rewarded. With that in mind, we'll take a few of your questions. If you want to type anything in the chat box, go right ahead. But to close, of course, we always try and build your portfolio with companies that they have profits that are not tied to politics, regardless of what happens in the economy or who's in the White House or who's in Congress. People will continue using Charmin, eating, taking their drugs, and using the cell phone. Sean, we've had a couple of questions come in between the chat box and beforehand. So the first question, I'll get you kind of covered it, but if you want to do a little more on it, were there any changes in the BBB impacting charitable contributions? I think you hit it, but should we change the way we do them?
Yeah, I mean, cash contributions is the key, especially if you're a non-itemizer. The running the stuff that Goodwill doesn't qualify for the above the line deduction. It's got to be cash. So if you're tithing to your church or given to a nonprofit, that may be a pivot on how you contribute. And then for the itemizers, you have that 0.5% AGI floor. So take a look at your AGI, get an idea of where you're at. And again, the reason, well, let's not get into the reasons. Most people are terrible because they're terrible, not because of tax deduction. Congress knows that. I believe they're trying to do a way as best they can with the Schedule A. So they're just making it a little bit more difficult. Give us on one hand, take away on the other. And then also with that 35% cap, if you are a big giver and you are in that highest tax bracket, there's some other planning opportunities that you can take to maximize this. So if you are in that situation, get with a tax advisor or a financial advisor and get some help with planning that. But short of that, the limits are what they are now. Yeah, but just keep it going.
All right, I'll slip in one place you can use charitable donations. If you're 73 or older and you have to take a required minimum distribution, you would want to donate to charity directly from that required minimum distribution. We'll just say there's a little tax savings on that. I won't go into the nuances, but that is a definite way to improve your tax position if you're looking to give to charities anyway. And that got enhanced with the big, beautiful bill changes that Sean's touched base on. But that's one I would encourage you to think about. We had a question sent to us about gold and silver. You may have seen this morning, gold hit an all-time high. Generally, when there's world uncertainty, gold becomes a place to put your money. Historically, if you look back, that has not been the case. There are just periods when gold and silver and metals do very, very well. And there's this guy, his name is Warren Buffett. And I kind of like what Warren says on many, many things. And his response about precious metals, and he said, I'll include Bitcoin just for the discussion. This was an interview he did some time back. He said, these are what he refers to as bigger sucker investments. Since they don't have a stable income that they're paying you, they don't pay any dividends, they don't pay any interest. The only way to get a higher price, in his words, is to find a bigger sucker. However, a recent discussion I'll mention, I'll refer to her as Amanda, not her real name, has an appointment with a jeweler to explore investing in gold as jewelry. She feels that's a wise and safe investment, and I encourage her husband to comply with her thought processes on that. So to close, always build your investment portfolio with companies whose profits are not tied to politics. Again, and please remember to follow us on social media. The QR code is up in the corner, and that's just linked to all sorts of different resources. Sean, do you have anything to add for us today?
Just wanted to thank everybody for joining. I hope everyone has a prosperous and incredible 2026. I'll end on this note. Try to get yourself to 80% signal and 20% noise. The media is designed to glue you in, bring you in, and keep you watching so they can sell advertising, and bad news sells. So keep that in mind, and we're here for you. If you have any questions or want to talk about anything you've heard on this slide, you know where to find us. Thanks again.
So if you know someone who would benefit from our webinar, we will also be offering a recording of today's presentation on the McCabe Gunn YouTube channel. Once it's posted, we'll email a link to all you registrants and attendees this morning. As always, feel free to share it with your family and friends. I'm checking in chat. I don't have any other messages showing there, so no other questions. Our next scheduled event will be our first quarter economic update. It'll be held Thursday, April the 30th at 10 a.m. We hope you'll join us. Thank you for joining us today. We look forward to meeting with you soon. Take care.